Ben Cowen from Intothecryptoverse is right. He's right to use the bull market support band to time Bitcoin, to get an idea where might Bitcoin bounce off of, where might it see a potential resistance, how can we potentially time the market. Now in his videos, Ben Cowen uses the bull market support band in conjunction with other tools. And he derives, for example, from this where Bitcoin dominance might go. But what about using this tool in a very simplistic manner? The idea would be that we buy whenever the price is above the bull market support band and we sell whenever the price is below, or we even bet on falling prices. Now this is the band on a live chart and it consists of the 20-week simple moving average. So that's here in red. And in green, we've got the 21-week exponential moving average. Now, if you've been following this channel for a while, you should know that I backtest strategies. I simulate buying and selling according to different criteria. And I also like moving averages. I usually backtest daily moving averages across different asset classes, across different altcoins, across different indices. And of course, I also made a backtest on Bitcoin. The best simple moving average historically for Bitcoin is the 124 day. And this is what we see over here. The simple moving average, 124 day. And have a look how similar those two charts are. This is the best backtested daily moving average. This is the bull market support band. Best daily SMA, weekly SMA and EMA bull market support band. Very, very similar. Now let's have a look at this backtest. It starts on the 17th of August 2017. Trading starts 200 days after that, so on the 4th of March 2018. And then we are trying to find out if we use this simplified strategy of going long whenever we are above the SMA and going short whenever we are below, what duration would have worked the best in the past? So is it the 200? Or should we rather go a bit shorter in duration and maybe enter a little bit earlier over here, exit a little bit earlier over here? Should we take maybe the 150 day, right? Note how the moving average gets closer and closer to the price. So when the bull market stops, you would be exiting a little bit earlier. Or is there maybe a point where it gets too short in duration? And then the problem is that we get these failed signals, right? When we get over here, in this example, we would be selling or betting on falling prices on the 21st of September. We would be selling low just in order to buy high again, just in order to sell low again, to buy high again. So these movements around the moving average, they are pretty expensive. You don't want to have these failed signals. But on the other hand, you do want to exit very early when a bull market stops. So it's basically an optimization between how many failed signals can you stomach and how early can you catch on bull and bear markets. Where do we have that right balance of spotting the momentum versus not overreacting whenever we see a bit of volatility? Or what's the best duration for a moving average? So here's the setup of the backtest. We bet on rising prices whenever the price is above the moving average. We bet on falling prices whenever we are below. We start with an initial capital of $1,000 and we do have a bit of a trading fee, 0.2%. We could also add a gas fee if we wanted to, but let's just work with relatively modest centralized exchange prices. We might even set this to 0, right? Some centralized exchanges allow Bitcoin trading for no fees at all. But let's do 0.2 and let's run the backtest with the macro. So now we've got 400 backtests that are being run. 200 for the simple moving average, 200 for the exponential moving average. We are now testing, depending on the duration of the moving average, what's the best SMA and what's the best EMA. And so this test takes a bit. It takes roughly 1 minute to run. And here we go. Here we've got our result in B. We've got the duration of the moving average. And in C, we've got the annualized performance trading according to the SMA and the annualized performance trading according to the EMA. And this is the same result, but displayed in a graph. So on the x-axis, we've got the duration of the moving average. And on the y-axis, we've got the annualized return. And then we've got two curves over here. The first one being the annualized returns for the SMA, the red one being the annualized returns for the EMA. And we see that for the simple moving average, we tend to perform better than trading according to the exponential moving average. This is actually a finding that can be observed for many cryptocurrencies when you run this backtest. A simple moving average tends to outperform. I don't know why that is, but it is a pretty consistent finding in 80 to 90% of the coins that I looked at. Now, how well does this work compared to buying and holding? Very well, because during the testing period, Bitcoin only made 19% per annum. And pretty much all the moving averages above 30 outperformed buying and holding. Before that, we've got a lot of trading fees, right? Too many signals. But once we go above 30, the outperformance is massive. Now let's look at the best point over here, which is the 124-day. And let's plot this on a chart. This is the result. So in white, we've got the Bitcoin price. In turquoise, we've got the backtested return. We started with $1,000 and this goes up all the way to 90,000, more than 90,000. There's a linear scale. Let's look at this on a logarithmic scale to see how consistent that outperformance is. The answer is very consistent, right? Here was the final capitulation in 2018, where apparently the miners sold. We shorted during this time, so we increased in value. The Corona crash didn't help us too much because the moving average duration is pretty long. But overall, right, this turquoise line is increasing quite steadily. And this is what I find so fascinating. The best simple moving average historically, the 124-day that's plotted here, it really doesn't look that different to the bull market support band, right? These curves are so similar. But the approach how we got to those lines is probably very different. I doubt that Ben Cowen made the same analysis, that he also ran through all of those different moving average durations to then find out that the 20-week SMA and the 21-week EMA worked the best. It might have been just eyeballing, right? And even the way those bands are used on his channel are different to how I use this moving average. So it looks like if you just look at those charts for long enough, you come to similar conclusions. I personally will still stick with the 124-day rather than a weekly moving average because I want to react quicker. The backtest that I ran does not trade within the day, so it just looks at the price once a day, midnight UTC to be more exact. But I like to not filter out too much data. But in the end, it seems to not even make that much of a difference. 124 days are 17.7 weeks, so slightly shorter than the bull market support band. But when you take weekly candles, probably a change in 1 or 2 weeks doesn't really move the needle. We can even see this in the data, right? The 124 is simply just in the middle of those well-working moving averages. You could also take the 136. 136 divided by 7 is 19.4. So we're getting very, very close to those bull market support numbers. There are more of those kinds of backtests on the channel. Feel free to check them out. Feel free to also join us on Telegram. Simply search for Bitcoin Strategy Channel within the Telegram app. There's also a link down below that you can simply click. Looking forward to see you there, and thanks for watching. Bye bye.